Hello there. Welcome to Financial Accounting N6. We want to look at a question from June 2023. This is the most recent question paper that we have for Financial Accounting N6. Right. This question is on statement of cash flow. And maybe we can start by understanding what we mean by a statement of cash flow. A statement of cash flow represents cash movement in and out of the business in terms of cash and cash equivalents. It also shows the cash generated in the business and how that cash has been spent over a certain period. So that's what we have in the cash flow statement. And we also have some adjustments that are going to be made in the cash flow statement in terms of operating activities, investing activities, and financing activities. So those are the three main categories that we have that are going to be adjusted in the cash flow statement. And obviously, we'll be finding the net cash flow balance at the end of the period in terms of operating, investing, and financing. Then we are going to add them to get the net cash position in terms of cash and cash equivalents. Of course, we will adjust again for opening balance of cash and cash equivalents to get the final balance of cash and cash equivalents. So that's what we have in terms of cash flow statement. So this question reads, the following information relates to Fanny Limited that distributes perfumes to retailers. The financial year ends on 31 August 2022. And all the required parts, it reads, calculate the following concerning the statement of cash flow for the year ending 31 August 2022. So that's where our year is ending, that is 31 August 2022. Then the first part of the question, they're asking the cash generated from operations. So we need to calculate the cash generated from operations. And second part is the net change in cash and the cash equivalents, right? So we can maybe concentrate on the first one there, the cash generated from operations. In this calculation, we are going to adjust for non-cash items first. We remove non-cash items. Remember, the figure that we are going to start with in the when we are now calculating cash generated from operations, we are going to start with profit before tax. And remember, when to arrive at the profit before tax, we adjust for non-cash items, e.g. depreciation. We also adjust for profit or loss of disposal. We've got also figures for provision for that. Those figures that I've mentioned, they are non-cash items. There's no cash movement, so we need to readjust them. Remember, at first we have subtracted them under operating expenses, and so in this instance, we want to remove them. By removing them, we do the opposite. Since we had subtracted them at first, right now we are adding them back, so that we remove them, so that we just go to the statement of cash flow with the actual cash position in terms of operating activities. So this is what we have in terms of cash generated from operations. So we are going to go to the answer section in terms of cash generated from operations, and we are going to start with the profit before tax. So we can go in the question and try to look at the profit before tax. So this is information that we are given in the question. We have gotten an extract from the statement of financial position of Fanny Limited on 31 August 2022. And we are given balances in 2021. So these are opening balances for 2021, and these are closing balances in the column for 2022. Then we have got balances in terms of the items that are listed here, represented by these figures. Then the question proceeds to say we have got an income tax note there. Income statement for the year ended 31 August 2022 is 369,000. This is 30% of net profit before tax. So this is the figure that we are going to start. This is where we are going to find the figure that we are going to start with in the calculation of cash generated from operations. Remember, as we said, we are going to start with net profit before tax. We are going to start with net profit before tax. So we are given the figure for tax, and the figure is being said is 369 here, and the rate that has been used to calculate this, find this figure, is 30%. And remember, to find the tax, we say the rate which is 30%, and then we multiply by a net profit. We multiply by net profit. So basically, we can just make a proportion there, because when we are when we are preparing this income statement, the tax is represented by the rate that we are given in the question, which is 30%. And then obviously the net profit now, the net profit that we are going to say 30% of net profit will be, the net profit will be 100%. And then the net profit after tax, after we've subtracted tax, will be 70%. 100 minus 30, 100 minus 30, then we get our 70%. But here we are given the figure for 30%, so we can just make a proportion there. We can just simply make a proportion there so that we find the figure for net profit. We want this figure for net profit, so we can make a proportion. Since we have got the representation in terms of percentages is 100%, we are just going to say 30%. 30 is equals to, we are given that figure is 369,000. 369,000. That's what we are given. Then the figure that we want is net profit here, which is 100%. So 100% now is equal to, obviously we get a more figure here, bigger figure. So we can make this proportion and say 100% is the figure that we want. So it's a bigger side. Or if you look at the side, it's a bigger side. So it becomes our numerator. And then the given percentage will be the denominator. And then we multiply by the given figure, 369,000 over 1. So if you do that, you are going to get a bigger figure there, which is 1,230,000. So this is the figure that we are going to start with in the statement that we are going to prepare to calculate cash generation from operations. So we can go and put that figure as net profit before tax in this section of the answer there. We are going to start with net profit before tax. Profit before tax. And then obviously we can summarize the working that we used there. We said 100 over 30. Then we multiplied by 369. Then we multiply by 369 over 1. So this is how we calculated that one, and then we got 1,230,000. So that's what we have at the beginning of the question. Then we are going to make the adjustments. So the adjustments that we are going to make here, we are going to make adjustments for non-cash items. We add them back, non-cash items, if they are there in the question. And then also we are supposed to adjust for interest. Remember, interest is adjusted under operating activities in the cash flow statement. Because here we are not yet in the cash flow statement. We are calculating a figure that we are going to use in the cash flow statement. So we remove tax, because tax was already subtracted when we prepared the income statement. So we remove it here and readjust it again in the statement of cash flow now under operating activities. So here we are going to adjust it again. So here we can write adjustments. We are now making adjustments. Adjustments in respect of so we check in the question the non-cash items, including interest, if we have those items in the question. If you come here, you would see that we have got interest. The issue of interest is being highlighted here. The interest on the loan is 15% per annum. The loan has increased halfway through the accounting period. Interest is not capitalized, or interest has been paid. The loan will be repaid in 2025. So this is just indicating that it's the period when it's going to be repaid. But what is important is this rate that is 15%. Remember, we want to calculate interest, and then we check our loan figures. We check our loan figures. So you see that our loan figures are given there. Loan is here. We are given this is 2021. This is 2022. So in 2021, the loan balance was 300,000, and then it increased to 2022 to 1,622,000. And then if we come here, we've got an instruction that we are given there. when the statement is saying the loan was increased, if you check there, the loan was increased. The loan was increased halfway. The loan was increased halfway through the accounting period. So what it means, it started as 300,000, then at the middle of the year, it increased to 1,622,000. So it means these amounts did not stay. We have got an amount which did not stay the whole year. But this 300,000, we are saying that it stayed the whole year from beginning of the year up to the end. But we've got a balance in between which came halfway through the year. So we need to calculate the interest separately. For the amount that we stayed after a year, we are going to calculate 15%. This is per annum. When you get that 15% for that stayed after a year, then we make a proportion of 6 months that that loan was taken. So when we make that proportion, we add now to the interest of the whole year of 300,000. So we can just make that calculation. Let's see here. We can just make that calculation here. You just make, let's see how we can calculate that one. Right, when you come here, we are going to say this 300,000, we are saying it's the whole year, so we are going to say 0.15 being this rate of 15%. Then we calculate, multiply by 300,000. So if you say 0.15 times 300,000, obviously you get 45,000 there. So this one applies for the whole year. This one was the interest for the whole year for this 300,000. Then we have got a loan balance which was introduced halfway through the year. So to find it now, we say 1,622,000, the balance we had at the end of the year, minus the balance that we had at the beginning. Then we find that one that was introduced during the year. So when we say 1,622,000, let's try to calculate that one. We are saying 1,622,000. Then we subtract 300,000. Then we are going to get 1,322,000. 1,322,000. So that's what we have. So this is the loan that was introduced midway through the year. So since we now know the amount, we can now calculate the interest now. So we are saying now we are saying 0.15. Then we multiply by this balance of the loan that was introduced to halfway. And then when we find the answer is going to be per annum year, so we reduce it to 6 months. Since it said 6 months, then we multiply by 6/12. So when we do that, when we calculate like that, we are going to get 99,150. So we have got interest of 45,000 and also interest of 99,150. So to get the total interest now, we add the two to get total interest. So here we can just say maybe total interest now is equal to 99,150 plus 45,000. Then we make that calculation. When we make that calculation, we are supposed to get 144, 150. So this is the answer that we have. So we can just go there. We can just go there and try to summarize that working that we used there to find the figure for total interest, that one. So here we can say interest. Then interest, we can put in brackets in terms of the calculation. Remember, we just summarize the working that we did there. We said 300,000 for the first one, and we multiplied by 0.15. That's why we got 45,000. And then we added the interest that we got by saying 0.15 times 1,322,000. And then we reduced it to 6 months, 6/12. So this is how we calculated that one. Obviously, this one goes the working there. And then we got 144. 144. See 144,150. So that's what we what we got there. Then we go back again to find any adjustment, any non-cash items. Remember, I said interest and also other non-cash items that are there in the question. So if you check this is the information that we have starting from the top. There we've got income tax. It's not going to affect interest. We calculated it. Then here now, that's where we are going to see the calculation of depreciation now. We are told that there are fixed assets which were bought during the year for 2,491,400, and then we've got fixed assets were sold during the year at book value. So we can take note of that one. They were sold at book value. At book value, we know that how to calculate that one. Calculation of book value, we say cost minus accumulated depreciation to find the book value. So that's what we have. Then the last point is saying the cost price was 500,000. This is of the non-current asset that was sold. The cost price was 500,000 rands, and the accumulated depreciation was 275. So to find the book value of this non-current asset that was sold, we are going to say 500,000. So basically, this is the book value. 500,000 minus 275,000. So when we do that, let's try to calculate that one. 500,000 minus 275. Then we get 225. And here you are going to get 225,000. So that's the book value of the one that was sold. And then we are told that there were fixed assets that were bought of 2,491,400. So that's what we have. Then we have got balances that we are given in terms of these non-current assets. If you go down, I think they are on top there. We have got these balances that we are given here. We are given fixed assets at carrying value. These are the figures at carrying value that you are given. You are given at the beginning of the year, we had 2,300,000 at carrying value as a balance. Then at the end of the year, we had 3,616,400 as the carrying value balance at the end. So we are going to present it in the form of a T account. Then we find the figure for depreciation. Then after that, we summarize the working now on the other section now. But here, for understanding sake, let's just put it a T account to simplify the working. We are going to say this one is the non-current asset account. Non-current assets account. So to find the figure for depreciation now, we can say we know that the carrying value, beginning balance. This is the beginning balance at the beginning of the year. We put it on the debit side. Then the carrying value when it's now the end value, the end balance at the end of the year, we put it on the credit side. Then disposal, the one that was sold is the one that has been disposed. So disposal at carrying value also come on the credit. And then the depreciation, this is the figure that we want to also come on the credit side like this. Then any purchase of a non-current asset will come on the debit side like this. So this is the calculation that we make when we are using the figures for carrying value. We put the as it is. So we are just going to input those figures that we are given in the question, and then we find the figure for depreciation here. The figure for depreciation here is a balancing figure. So let's see with the balances that we have. We see this is the first row here. That's where we are having carrying values. This is at the beginning. This is at the end. So we can just try to present it again in the form of T account. And then we are saying 2,300,000 is the one that we have at the beginning of the year. So it comes on the debit side, 2,300,000. This is this one carrying value at the beginning, 2,300,000. Then the carrying value at the end is 3,616,400 is the one that is on the credit side. So it comes here, 3,616,400. And then the disposal at carrying value, remember we calculated it. Let's recheck it. Disposal at carrying value, we calculated it here. This is the disposal at carrying value. We said 500,000. This one, it was the cost price of the disposed asset. And then the accumulated depreciation 275. And then we said 500,000 minus 275,000. Then we got 225,000. So this is the carrying value at disposal. So we go back to our T account. And we are saying the carrying value at disposal come on the credit. So you're going to put again 275,000 there. 275,000. Right. So with that now, we can now then we've got the purchase. We've got the purchase there. The purchase at cost is on the debit side. So we find it here. The purchase at cost. We check it again in the question. What amount we have for the purchase at cost. So you see that we are given that figure there. The purchase is here. First point on item 3. Fixed assets were bought during the year of 2,491,400. So we're going to put it on the debit, 2,491,400. So we have 2 million. We have 2,491,400. And for depreciation is on the credits is this figure X that we don't have. So to find this figure, we're just going to say this one plus this one minus this one minus this one. We'll get this one. So this is the working that we are just going to summarize on the other section. So this is the figure for depreciation. So for depreciation in brackets, we are going to say 2,300,000. Then we add 2,491,400. Then we subtract 225,000 net book value. Net book value of that non-current asset that was disposed. Then we've got the balance at the end. It carrying value 3,616,400. So by making that calculation here, the figure for depreciation that you are supposed to get is 950,000. So that's the figure that we gave there. So you see that these are the only adjustments that we are going to make here in under adjustments in respect of. These are the only adjustments that we are going to make. So we are saying these amounts depreciation, we are adding them back, and then interest also we are adding them back. Initially in the income statement we had subtracted them. Now we are doing the opposite to remove them. So we add back. So that's what we are going to do. So we will add them to this figure of 1,230,000 at the beginning of net profit before tax. So that's what we have. Then when we add them, we are going to get operating profit before changes in working capital. So that's the figure that we are going to put there. We are going to get operating profits. Operating profits before changes in working capital. So what is going to happen is that we are going to add 1,230,000 there. Then we add this 144,150. Then we add also 950,000. And then the figure that you are going to get there is 2,324,150. So this is the figure that you get. And then beneath that, now we are going to adjust for changes in working capital. Changes in working capital. So here we are going to have changes in working capital. So the changes in working capital, we're going to identify them in the question. But basically, we can just start by understanding what we mean by working capital. What we mean by working capital. Working capital is current assets minus current liabilities. So in other words, in changes in working capital, what we are saying is we are going to look at movements that we are going to see in current assets and also components of current liabilities. So components of current assets and components of current liabilities, the changes that we are going to notice in terms of increases and decreases. For example, if we're trading stock as a current asset, we are going to see if there's an increase in the trading stock, or is there a decrease in trading stock or trading inventory. So we adjust for that. But basically, when there are current assets, when there is an increase, the adjustment that we make is that we subtract. We make a negative effect in the statement, in the case statement that we are preparing to calculate cash flow from operations. But if there's a decrease in current assets, we add. So I think that's what is very important. And then also it applies to current liabilities. Remember, we are saying working capital there is being calculated as current assets minus current liabilities. So this is the effect that we have on current assets. But on current liabilities, it becomes the opposite. When there is an increase, we add. When there's an increase, we add. And when there's a decrease of current liabilities, we subtract. So that's what we have. So we can just go and check in the list of balances that we have. We check the components that are there. Are they current assets or not? So you see that the first, which is within current assets, is inventories. And we are saying that inventory is moving from 2021 to 2022 is from 1,044,700. Is decreasing to 903,900. So that's a decrease. That's a decrease. So let's calculate the decrease. It's 1,444,700. Then we subtract 903,900. So that's what we have there for inventory. Decrease in inventory, and you're going to get 140,800. 140,800. So remember, this is a decrease, and we said whenever there's a decrease, we add. So we are going to make an addition of that one, and we are just going to say decrease in trading inventory. So here we say decrease in inventory, and obviously in brackets we're going to show the working there. We said 1,044,700, and then we subtracted 900, 903, 900. 903, 900. Let's again recheck that the actual figure of where it's moving to is 903,900. That's the figure that we have. Right. So the answer that we got there is 140,800. 140,000. And we are saying this figure is a positive. So we leave it like that. So we go to the next one to see what's the next balance we have. From inventory, we have got debtors. But debtors, we are seeing there it's from 7950 to 257,150. But we've got a note that we have there beneath that is explaining something about that the components of debtors. We are here. Debtors are listed here. We have got 2021 and 2022. And we have prepaid expenses, SARS, pay as you earn as payee, and then we've got SARS in the form of income tax. So there, what we are supposed to do there, we have to also include some other receivables. We're going to add them to the figure for debtors that we have. So you'd see that the figure that we are only going to exclude there is the figure for SARS income tax. SARS income tax is not going to be part of the debtors, because remember, when we are talking about debtors, we are talking about the people of business that are owing us money, but in the form of trading. So this figure for SARS income tax is not part of the trading activities that we are undertaking in that business. So we don't include this one, which is 49,000. So we are just going to say this was the opening balance. The opening balance is 70,000 plus 650 plus 300. So we can check to see what movement was there. At the beginning, we had 70,000, and then we added 650, then we add again 300. So to see that we have 70,950. 70,950 there. 70,950. And then if you check here now, it becomes 0.5. It's this one, because you're just adding this one and this one, and then 6 plus 5 here with 11, 8. Maybe here we got 208, 208,150. So that's what we have. So you are seeing that the movement that we are having there, we are seeing an increase. It's an increase of trade debtors, and it's an increase of a current asset. So whenever we have got an increase of a current asset, we say it's going to be a negative in the calculation of cash generated from operations there. So what we are going to do, we are just going to summarize the working there in the other section, and then the balance that we are going to get, we represent it as a negative figure. So we can go there. We can go there to check what we have. Right, we are now here. We are now there. We can check there now what we can how we can adjust that one. Right, we said it's an increase. It's an increase in debtors. So the working now, we can summarize it. Remember, the bigger figure there is the one that we can put paste there. We say, was it increased? So it was 207,650. We added 500. And then we are going to subtract the other part there, the other part that we are going to subtract, we can put in brackets again. We are going to subtract 70,000 plus the 650 plus 300. So in brackets, so here you can put bigger brackets here. Then we say when you find this total, then you subtract this one. Then if you calculate that one, if we calculate that one, right, let's try to see what we get there. So we get 137,200. 137,200. And remember, we said this figure we're going to put it in negative. since it's an increase of a current asset, it's a negative, right? So if you check in our question, the next working capital movement that we are going to have, we can check there in the question that we have, right? In the question that we have, we are only left with let's try to see which are adjusted for debtors. Let's look down there if you have got any other there that is right. We now have creditors. These are the last ones that we are going to that are affecting working capital, right? For creditors again, we are not going to include the figure for SARS income tax, and also the figure for shareholders for dividends is not part of our trade and other payables. So remember, we've got creditors here. So we are only concerned with income received in advance. So we are going to add the figure that we have for trade creditors, and we add with the figure for income in advance. So basically, if you try to summarize there, we'd see that at first we had 860,700 at the beginning plus 28,300. That's what we have. And then at the end, we have got 934,300 and then 10,500. So you see that at the end, that's when we have got a bigger figure. So we are going to say 934,300, then we add 10,500. So this is the first, the total at the end. Then we subtract the total at the beginning, whereby it's 860,700 and we add 28,300. So that's what the calculation that we are just going to summarize there. And you would see that this is an increase of a current liability. And whenever there's an increase of a current liability, we are going to see a positive. So we leave the answer as a positive. So we go there in the answer section and summarize that one. So this one is an increase in creditors, increase in creditors, and then we summarize the working there. Let's try to summarize that working. So this is the working that we already, right? We're going to say 934,300, and then we add 10,500. 10,500. So that's the first total. Then we subtract 860,700. 860,700 plus 28,300. Right. After making that calculation, you're going to get 55,800. So that's how we arrived there. So this one is the last adjustment, and then we calculate now cash generated from operations. Cash generated from operations. So basically, what we are going to do there to arrive at that figure, we go there. We have got operating profit before changes in working capital. This one 234. So 2,324,150. We add 140,800. We subtract 137,200, and we add 55,800. So we calculate that we supposed to get here. We are supposed to get 2,383,550. So this is the cash generated from operations figure that we were looking for. So that's what we have in terms of cash generated from operations. But if you go back to the question, we have got at the last part of the question is saying net change in cash and cash equivalents. Net change in cash and cash equivalents. But what we know is the formula that we use at the end of the cash flow statement of cash flow, we say net change in cash equivalents. Then we add it to the opening balance of cash and cash equivalents. Then we get the closing balance of cash and cash equivalents. So the figure that they are asking is this one. But we have the figure for opening balance and we have the figure for closing balance. So simply there, to find the figure for net change and cash equivalents, we can make this one the sum of the formula. This one we can make it sum of the formula there. So then it becomes closing balance minus opening balance. Closing balance minus opening balance. So there we are going to the question now and try to see the closing balance and the opening balance, what we have. In the question, you see that cash and cash equivalents we are given there on top. Let's go and check the figure that we have for cash and cash equivalents in the beginning and end. At the beginning and end, you see that we are given there the figures for cash and cash equivalents. At the beginning, we have negative 61,000. And then at the end, we've got 70,000. Those are the figures that we have. At the beginning, it's negative 61,000. So what we are going to do there, we are going to say it is equal to closing balance. Closing balance, we are given it as closing balance, we are giving it as given is 70,000. Then we subtract opening balance to negative 61. You see now. That's what we have. So here we have a negative. We check here, we've got a negative that is here, and also a negative that is here. So a negative and negative will make a positive, and then it becomes 70,000 plus 61,000. So our net change in cash and cash equivalents now will become 131,000. So this is the case that we have. So this is our net change in cash and cash equivalents. So that is what we have, guys, in terms of this question of statement of cash flow. This is financial accounting N6. Stay tuned for more videos to come as we prepare for exams. I wish you the best again in your exams. Those who haven't subscribed, please subscribe for more videos that are going to come so that you get notifications of videos that will come. We meet again in the next video. With that, I'm signing out.